Module Overview. Introduction to Sources of Finance. Sources of finance refer to the various channels through which an organization raises capital to fund its operations, investments, and growth initiatives. Understanding these sources is fundamental to making strategic financing decisions that balance cost, risk, control, and flexibility. Organizations can access finance from internal and external sources, each with unique characteristics, costs, benefits, and implications for the firm's capital structure and governance. Classification of sources of finance. Internal sources. These originate from within the organization and typically include retained earnings, depreciation funds, and sale of assets. Internal sources are often the cheapest and least risky, as they do not require external obligations or dilution of ownership. External sources. External financing is obtained from outside the organization and can be broadly categorized into debt and equity. Debt financing. Involves borrowing funds that must be repaid with interest. Common forms include bank loans, bonds, debentures, and commercial paper. Debt financing is attractive due to tax deductibility of interest, but increases financial risk and leverage. Equity financing involves raising capital by issuing shares to investors. Equity can be common or preferred stock. Equity financing does not require repayment but dilutes ownership and may involve dividend obligations. Hybrid instruments. These combine features of debt and equity, such as convertible bonds and preference shares, offering flexibility in financing and risk management. Characteristics and implications of major sources. Retained earnings. Profits reinvested in the business instead of being distributed as dividends. They are cost-effective but limited by profitability and may signal lack of dividends to shareholders. Bank loans. Provide fixed-term financing with agreed interest rates and repayment schedules. They require collateral and can impose restrictive covenants. Bonds and debentures. Long-term debt instruments issued to investors. Bonds can be secured or unsecured and may include callable or convertible features. Equity shares. Provide permanent capital but require sharing control and profits. Public equity involves regulatory compliance and market scrutiny. Venture capital and private equity. Equity financing from specialized investors who provide capital and strategic support, often for startups or high-growth firms. Capital structure, concept, and importance. Capital structure is the specific mix of debt, equity, and other securities that a company uses to finance its overall operations and growth. The optimal capital structure maximizes the firm's value by minimizing the weighted average cost of capital, WACC, and balancing risk and return. Key considerations in capital structure decisions include cost of capital, 0.000, balancing cheaper debt financing with the higher cost of equity, financial risk. Managing the risk of insolvency and bankruptcy due to excessive leverage, control considerations, avoiding excessive dilution of ownership and decision-making control. Flexibility, maintaining the ability to raise funds quickly for future opportunities or emergencies. Theories of capital structure. Several theories explain how firms decide their capital structure. Net income approach. Suggests that lower cost of debt increases firm value, hence, more debt is preferred. Net operating income approach. Claims capital structure does not affect firm value, the overall cost of capital remains constant. Modigliani-Miller theorem without taxes, 0.02, proposes that capital structure is irrelevant in a perfect market without taxes, bankruptcy costs, or asymmetric information. Trade-off theory balances tax advantages of debt with bankruptcy costs, suggesting an optimal level of debt. Pecking order theory. Firms prefer internal financing first, then debt, and issue equity as a last resort due to information asymmetry and signaling effects. Agency cost theory. Focuses on conflicts between managers, shareholders, and creditors affecting capital structure decisions. Factors influencing capital structure decisions. Business risk. Higher operational risk suggests less debt usage. Tax considerations. Interest on debt is tax deductible, making debt attractive. Financial flexibility. Ability to access capital markets when needed. Company size and asset structure. Larger firms with tangible assets can borrow more easily. Market conditions. Economic climate, interest rates, and investor sentiment impact capital raising. Management style. Risk tolerance and strategic priorities influence financing choices. Capital structure and firm value. The right capital structure enhances firm value by lowering the cost of capital and increasing financial efficiency. However, excessive debt increases bankruptcy risk and financial distress costs, potentially eroding value. Balancing these effects is crucial for sustainable growth. Practical considerations and challenges: access to capital markets and creditworthiness, regulatory and legal constraints, market volatility and interest rate fluctuations, aligning financing decisions with strategic business goals, ethical and stakeholder considerations. Summary: this module provides an extensive understanding of the various sources of finance, their characteristics, and strategic implications for capital structure decisions. It empowers you to evaluate and design optimal financing strategies that align with corporate goals, risk tolerance, and market conditions.